Employee loan, what it is, and should you get one? An employee loan is a loan provided by an employer. These types of loans are not offered by every employer, and they can differ widely in terms of eligibility requirements and other specifics. But if you need to borrow money and don't qualify for a personal loan or simply want to explore other options, it could be worth asking about an employee loan. How an employee loan works. So if your employer offers employee loans, they might be tailored specifically for your company, but the process can be similar to that of a traditional personal loan, where you complete a loan application, wait for approval, and if approved, receive the funds in your bank account. Typically you will repay the loan over time with the money deducted from your paycheck. Loan term and amounts will vary by employer. For instance, Equifax has an employee loan program that offers loan ranging from $1,000 to $35,000 depending on the employee salary. The Virginia State Employee Loan Program has a $500 maximum, while employee loan often charge interest. Their rates tend to be lower compared to other borrowing options, including personal loans, credit cards, and especially payday loans. The Equifax program, for example, offers annual percentage rates of 5.90% to 19.90%, while the VSELP charges 24.99%. Types of employee loans. So in general, there are two types of employee loans: those that come straight from your employer, and ones that are offered through a partnership with a bank or other financial institution as an employee benefit. If you get a loan straight from your employer, it could be in the form of the employer paying upfront for something you need. For instance, your company might cover costs related to buying a home or a car, after which you had pay the money back to your employer. Otherwise, your employer may refer you to its partner bank, which will evaluate your application, and if you are approved, lend you a lump sum of money. Example of employee loan. There are a few different types of employee loans. For example, you might be offered one of the following: unsecured personal loans. Unsecured personal loans tend to be offered by employers through a partner lenders, unless your employer is a financial institution, in which case it might administer the loans itself. Your employer sets the minimum and maximum amounts, repayment terms, interest rates, and eligibility requirement. For instance, you might be required to work for your employer for a set number of months before becoming eligible. Transportation loans. Some employers cover the cost of transportation to and from work as an employee. Work others will front you the money to pay for transportation related costs such as bus or subway pass, but the cost of this loan may be repaid via deductions from your paycheck. Vehicle or auto loans. If you frequently need a car for work, your employer might help you pay for the cost of one. This can come in many different forms depending on your employer. For example, your company might contribute to the down payment, helping lower your monthly payment. It might also pay a portion of your monthly payment based on how much you use the car for work. Advantage and disadvantage of employee loan. Like any loans, employee loans have their